Khoon Goh, head of Asia Research at ANZ, is now joining us from Singapore. Khoon, thank you very much for your time. Now, it appears that a variety of factors are coming together. First, the weak data, macro data coming out of US, which actually triggered that it's a growth concern, not necessarily a issue of inflation getting under check. At the same time, what's happening in the Middle East, and then, of course, how can we miss out Japan? How do you see all these factors play out in terms of fund flows purely for emerging markets like India?
Good afternoon. I think the initial trigger for this massive sell-off is the unwinding of the yen carry trade. Now, this really started a couple of weeks ago and started to gain momentum. And then when you overlay on top of that, the recession concerns following the weak US data, and of course, the fear around an impending attack by Iran over the weekend, I think all that just caused further paring back of risk by investors. And just to complicate factors, we are also in a period where liquidity is quite low because historically the month of August tends to be a period with the Northern Hemisphere summer where a lot of people are away on holiday. So therefore liquidity tends to be lower than normal. And then you have huge event risk like what we're seeing now that just causes huge gaps and moves within markets. And I think today the further unwinding of the yen carry trade has triggered potentially further stop losses and perhaps even margin calls, which then further see further losses and slippage in the pricing.
Explains the backdrop as to what is happening and why is it happening. The question is what next now, Khoon? There's a lot of this increased chatter and clamor around rate cuts coming in from the US and a lot of chatter around an emergency meeting coming in. Of course, it's not confirmed or not that it's coming in from official channels, but what do you see the probability of that, if at all? And is September pretty much priced in then?
Look, the markets is already pricing in a high chance of a 50 basis point rate cut for September, and almost 5 full 25 basis point rate cuts by the end of the year. So market has swung quite aggressively towards expecting the Fed to slash rates very aggressively. Now, I think to me this seems to be an overreaction because if you look at the real economy in the US, it doesn't feel like it's teetering into recession. Yes, we had weaker than expected non-farm payrolls number. The unemployment rate did tick up to 4.3%, but 4.3% is still historically very low. There's a lot of people putting a focus on the Sham rule that has been triggered, but this is the first time we'll see, whether or not it really does lead to a recession as what the historical backtesting suggests. So it's not entirely clear that the US economy is slipping into a downturn which warrants aggressive easing from the Fed. Now, market reaction has been severe, but again, I pin that down to an unwinding of the yen carry trade rather than the recession fears necessarily. And if it's purely an unwinding of the yen carry trade, at some stage, once the liquidation is done, you'll see markets calm down and we'll see probably a rebound. And that wouldn't require the Fed or any other central bank to come in and rescue the markets. I think we just have to let markets, play things out. And as long as there isn't any contagion or spillover effects into the real economy, I think that's where central banks will be most focused on.
Understand how legitimate is the fear of US slowdown actually having an impact of overall growth slowdown in the rest of the world?
But if you look at the rest of the world, particularly in Asia, the growth has actually been holding up very well. We've seen huge, strong pickup in exports right across the board, driven by the tech sector. We've seen GDP growth in this region coming in quite strong. PMIs generally are still riding above 50, which indicates an expansion territory. And the biggest growth concern has been previously around China, but even then we started to see policymakers coming out and committing towards providing more support to boost household consumption. So in terms of the real economy and how the global economy is tracking, it's actually performing reasonably well. And the recent jitters around the US, just because we had a slight tick up in the unemployment rate, again, to me, feels like a bit of an overreaction in the near term.
Khoon, just before we let you go, when do you where do you see a bit of a stabilization happening for yen, at least at the moment? And do you expect any policy action or any intervention from the Bank of Japan or even in Korea and other places?
Well, we haven't heard or seen any official comments from either the Ministry of Finance or the Bank of Japan officials around the sharp rally we've seen in the yen. I think we're probably looking at potentially the next key level in dollar yen at 140. We might see the market start to stabilize around there, but a lot of it depends on whether there's further to go in terms of this unwinding of the yen carry trade. I think markets have really put on this trade over a long period of time, trying to take advantage of cheap yen funding, and that worked out well for the first half of this year. We're starting to see that trade unravel very quickly. There could still be a bit more to go, but I think the 140 level in dollar yen, I believe, should hold if we do get there.
Thanks, Khoon, for making time and speaking with us and helping us understand what is happening in the markets right now and what perhaps should we expect next.